In today's video, we are going to talk about 3 stocks that some investors are super bullish on, but other investors would not touch these stocks. Before we dive into the first one, I just want to thank AG1 for sponsoring today's video. And remember, nothing in this video is to be taken as financial advice. Please do your own thorough research before making any investment decisions. I won't be including Palantir nor Tesla in today's video, although I do recognize that these are 2 of the most controversial stocks at the moment, but you've only got to go and look at my main channel to see how I feel about these positions. The first one up today is Alibaba, ticker symbol BABA. In case you didn't know, they are a Chinese massive multinational conglomerate company that specialize in e-commerce, retail, tech, and much more. They've even been called the Amazon of China, which is a pretty big statement. At their core, Alibaba is an online ecosystem, and one of their flagship platforms is Alibaba.com, which is the world's largest wholesale marketplace, but it doesn't just stop there. You can see on the screen now all the other things that they do, and there is many. Okay, so let's first talk about why some investors are so bullish on this company and can't get enough of the stock in their portfolio. And then we're going to move on and talk about some of the reasons as to why some investors would never add this position. Alibaba holds about 50% of the Chinese e-commerce market. They have a very substantial market share. And I think the reason they have such a large market share is because of the ecosystem they've carefully crafted. Now in 2023, they actually underwent quite a massive growth plan, which actually included splitting their company into 6 different business units. This has seen some success, but it's definitely not been completely successful because, for example, the cloud computing arm of this split has been cancelled. However, the Chinese e-commerce market is expected to see substantial ongoing growth. There is more room for Alibaba to actually grow. Experts have said that they actually expect this market to grow at a compound annual growth rate of about 8.21%, with the worldwide market growing at about 15% until 2032. Now I, like you, hence why you're watching videos online like this one, care about securing my financial future. But alongside optimizing my financial health, I also want to make sure I'm putting effort into my overall wellness. And it's really cool that I'm able to now share this with my audience. To explain it simply, AG1 is a convenient science-driven blend of over 70 vitamins and minerals and other ingredients that support your daily nutrition. It honestly makes it super easy. I just mix 1 scoop into cold water and it tastes really good. It tastes fruity, actually pineapple-y and a little bit earthy. I quite like it, but my preference honestly is to have it with ice. So I shake it up over ice and that tastes perfect. I know you guys watching this video are busy people, and I know also that you care about investing into yourself and optimizing your life. And the number one thing that I've noticed from drinking AG1 each day is that I feel a boost of energy and focus, which is very needed for trying to increase your revenue streams. My mental performance has honestly been better since I started drinking AG1, and I felt less tired and fatigued, which has then helped my productivity. There is so much going on with AG1 that I could speak about, but they are so confident that you are going to feel the benefits that if you don't feel 100% satisfied within the first 90 days of your first order, they will give you your money back. So head over to drinkag1.com/StockSpeak. I'll also leave that link in the description, and I will pop a QR code on the screen now that you can scan too. This will give you 20% off your first order when you subscribe, and you'll also get a free 1-year supply of vitamin D3 and K2 and 5 AG1 travel packs, which are super useful, and I actually used these recently when I took a trip to Prague. So thanks again to AG1 for sponsoring this video. Alibaba recently reported their earnings on the 14th of May, and overall they were pretty good. They saw increased revenue of about 7%, beating estimates, but they came just short of the EPS estimates. Now these earnings were pretty decent, especially given that they actually operate in a total of 6 main segments, and I believe that they saw growth across all 6 of these. So they saw good revenue growth, and at the moment they are trading about 15 times price to earnings, and they have a good free cash flow. But like you can see on the screen now, following these earnings, the stock fell quite substantially, which was not really warranted in my opinion, but this does seem to be the theme of this earnings season. Unless a company comes out and completely dominates estimates, and they give really, really strong guidance, the stock seems to suffer. So now we need to discuss why this stock is a little bit controversial and why some investors will not go near it. Now, the main overarching reason for this is because this company is a Chinese company. It's a Chinese stock. And this means that there are heavy regulatory interventions and policies that surround it. And of course, there are also geopolitical tensions that could actually add to the uncertainty. So what I would say is if you are a foreign investor wanting to invest into a company, into a stock like Alibaba, you need to be okay. You need to be able to stomach the volatility of China's political, regulatory and economic climate. Another thing to consider here is that China's economy has been seen to continually struggle as the lingering impact of the lockdowns are still occurring. However, the latest data that has come out has showed us that their economy is now on the mend. So this could be potentially bullish for companies like Alibaba in the future. Let me know if you would add this stock to your portfolio in the comments below. But now let's move on to the second stock in today's video. Now this second one is actually a really, really interesting company. It's Transmedics Group, ticker symbol TMDX. I actually spoke about this stock in a video that I made on this channel that came out on the 2nd of April. I will put the video up here if you want to check it out, maybe after you've watched this one. But anyway, since then, this stock has returned over 90%. Now, hindsight is a beautiful, beautiful thing. And, you know, I wish I had invested when I made that video. Being transparent, I did not. It was an interesting company, but it wasn't one where I needed to put my money urgently. Hindsight's great, but, you know, there are risks with this company. There are things that could be controversial that may put some investors off, and we'll discuss them in just a minute. But first, let me explain what this company does and why some investors really, really like it. So they are a medical technology company who are focused on organ transplantation. They have a technology platform called OCS, which stands for Organ Care System, and this is a revolutionary technology, and it basically helps to preserve organs that are used in, you know, organ transplants and treatments at the end stage of heart and liver failure, and it helps to keep them in a more natural environment to mimic what they would be like in the body. And unfortunately, probably just due to the general health decline of people not looking after themselves in today's world, there is a larger need for organ transplants, and that doesn't seem to be slowing down. But the problem right now is that the supply is limited. The supply of organs is limited. Now, of course, this is partly due to just there being a limited number of organ donors, but also the other issue is that there is an inability to actually get functioning organs from a donor to a recipient. Usually and historically, cold storage is the method that is used, but like I said, they are now trying to replicate the natural environment in which the organs are in, which then basically extends their shelf life to get these organs to recipients. So they are doing a really great thing in my opinion. But, the OCS, this organ care system, is about $80,000 per use. So it's very, very pricey. And this, of course, at this current point in time, could actually limit the adoption. Now, I think the reason that this stock has gone up by such a big amount in such a short space of time, like I was saying, over 90% since the 2nd of April, whenever I released that video that I just told you about, the reason for that is due to their Q1 results, which were impressive. You know, both bottom line and top line were above estimates, and they raised their sales guidance for the future. So all looks good, right? But some people wouldn't want to invest into this company. Why is that? Why may it be a little bit controversial? Well, I think firstly, it's just the sector that this company is operating in. Some investors do not want to touch biotech companies, or companies within the medical sort of sphere. And that is often because sometimes it's a bit slower growth. You know, sometimes a growth stock like an Amazon may be a better option. But also you've got to consider that there are really, really stringent regulatory guidelines and issues within this sector. It's very, very hard, it's long, it's difficult to get the right approvals that companies need for their products. You know, FDA approvals, for example. However, Transmedics Group with this OCS system is FDA approved. The only technology like it that is actually FDA approved. So that is quite a big thing. Also, very, very expensive could limit adoption. And then you've got this idea of, this is quite niche. This is not so widespread as maybe a stock like, I don't know, Amazon or Google, maybe. Sure, everyone has organs, that's a given, but not everyone needs organ transplants, touch wood that most people don't in their life. And it is quite niche, and that could limit growth in the future. They're going to have to keep innovating, keep adapting, and that is quite difficult in an area like this, like I said. The third stock is one that also operates within the e-commerce space, but this time primarily within Latin American companies. If you haven't guessed already, it is of course Mercado Libre. I hope I'm saying that right, but the ticker symbol is MELI. Now, I've seen some investors over on X and on YouTube that are super bullish on this position and actually makes up the majority of their portfolio. If you are one of those, let me know in the comments below. They posted great Q1 results, exceeding both revenue and earnings estimates. One thing that I really like about this company, and I've only done limited research, I'm not an investor into this company, I'll be completely transparent. Maybe I will be in the future, who knows? But one thing that I really like is that they don't only operate in the e-commerce space. They are bigger than that. They also offer fintech services under their brand Mercado Page. These include things like online payment solutions, credit services, and much more. But they also have an advertising portion of the business and other stuff. So the point here is they are not limited to e-commerce. A bit like Amazon, I guess. There's many things going on there. They saw growth in a couple of their key markets, namely Brazil and Mexico, and they also noted very good performance in their fintech unit that I was just telling you about. Now, valuation-wise, at the moment, in my opinion, and obviously not financial advice, do your own research, they are looking quite attractive. However, why might this be a controversial investment choice? Now, kind of like the same reasons that we saw with Alibaba, they are not a US-based company. They don't operate within just the US. They are actually operating outside of the US, and therefore there is some maybe unpredictable economic instability. With this company, they are actually operating in perhaps more volatile economies like Argentina, which of course right now is experiencing quite a lot of uncertainty and currency devaluation. And the second reason is that across Latin American companies, there is changing regulations and political issues that could impact operations and profits of this company. That's not guaranteed, but some investors would rather just stick to US companies and maybe play within the territory that they are more familiar with. Others like to take the risk, and they may pay off. Of course, we don't know that yet. Remember, if you do want to check out AG1, which I highly recommend you do, head over to drinkag1.com/StockSpeak. I will also leave the QR code that you can scan on the screen now, and there is a link in the description below. As always, let me know if you have any of the stocks we discussed in today's video in your own portfolio and your general thoughts on them. Until next time, keep analyzing, keep investing, and don't forget to hit that subscribe button.